We are going live. Let's see how this works. Let's see what happens here. It's not a good sign, not gonna lie. Oh, here we go.
Here we go. We
All
are
right,
live.
we got this figured out.
We are
live. All right, so this is the beauty of using new technology. What's going on, cash flow hackers? It's Chris with Life 180, and I'm here with my buddy Mike Fritz from Power Up Real Estate. And I'm actually going to go live over here on TikTok as well, so this is going to be a little bit fun. Mike and I live not far from each other, and we've committed to doing some more content to be able to, serve everybody, because there's a lot of stuff going on in the world. I have my expertise. He has his expertise. There's a lot of overlap, a lot of synchronicity, and I just feel like we both see the world through a very similar lens, and so it's just a really big opportunity for us to come together. A, it's a lot of fun. B, I think we can add a lot of value. And to everybody on TikTok, thanks for being here. I'll be checking in on questions over there every now and then as well. So, and if you're not following me on TikTok, guys, go to at Real Chris Kirkpatrick on TikTok. You're not there yet, are you?
No, dude.
What the heck, man?
Every single time I hear of a new platform, I'm like, man, I'm trying to. And so, no, but yes, I am going to be launching TikTok soon, so
That's
that we
awesome.
can keep serving people.
Rock and roll, man.
Keep serving people, man.
So today's video, Mike, we're going to be talking about is the real estate market going to crash? Right?
That's what everybody's asking right now.
Totally.
It's what everybody's asking.
And so I've been doing some videos on inflation, on the real estate market going to crash, just kind of what's going on in the world and what are the different moving factors, because we have, inflation going out of control.
For sure.
We have debt going out of control. We have interest rates going out of control. And all these things typically are main indicators that we would look at and say, oh my gosh, if interest rates went from 3% to 6%, most people would be like, oh my gosh, that's going to be a complete calamity in the real estate market.
Exactly.
Yet we haven't seen anything happen.
Seen it. Yep,
right?
Exactly.
So, I mean, we're on the same page with this. So I'd love just, if you can, just kind of walk through of why there seems to be this disconnection between common financial principles on how economies and markets go up and down with these different things going on, and why there seems to be this massive disconnect right now.
Well, there's a little bit of a disconnect, I think, because the logic says rising interest rates, then what happens? People don't buy anymore. Oh man, it's going to stop buying. And what Robert Schuller in the Schuller Report, and if you know anything about Robert Schuller, he's one of the brilliant financial minds of our time, and he does a lot of things on interest rates and how interest rates impact buying patterns, and he does a lot of financial data. But one of the data he has proved throughout time is rising interest rates don't slow down house buying. But what it does do is it will decrease the size of home somebody will buy. So instead of buying a $600,000 home, they'll buy a $500,000 home to make up for that different payment. Because while most people actually don't care about the price, they care about the payment. Totally. And most people they want to know, what's my monthly payment and can that fit into my monthly budget? By the way, that is a big no-no. The idea that all that matters is if my paycheck to paycheck will cover it, that's a poor financial way to think. And we want to rip you out of that and to see the bigger picture of why you buy the size of home you do and all of that, which is a whole nother video. But most people make decisions based on the payment. Well, that being said, that's not really impacted by the interest rates, in the sense that I can just slide the number down of the size of home I buy, and the payment is the same. So if my payment's going to be $2,500 a month, then I figure out, okay, instead of $650, I can bring that down to $500, and I'm good, or whatever that number is. And so it doesn't really change it. And so we're not going to necessarily see the speed of homes slow down, and for two reasons. One, just data, and second, because we still have such a distance in the supply and the demand. The demand is so far out in front of supply right now that if one person doesn't buy it, 5 others are waiting. So it can't slow down under this sector right now, in the way that it's set up.
Totally.
Yeah, you know what I mean? And so I think sometimes we get into this, and you speak to this too, Chris. Yeah. Sometimes we get into these where the logic says X, and so we make a real estate decision. For example, in the last 4 or 5 years, people have been real estate investors. Oh, I'm just waiting on that next crash. Its logic says, man, things are booming, it's going to crash. Well, the last 2 years proved no, it can go up a whole lot more. And so when we make decisions based on just logic rather than data, we get in trouble.
Yeah, there's no doubt about that. And so I think you touched on a couple things, and it's important to understand, all the moving factors that go into why real estate does whatever it does, right?
Exactly.
And I think it's really easy to look at the interest rates as just being the example. So let's just kind of go back in history, back to 1980, the end of 1979, when interest rates were, you get a mortgage rate, let's just call it 20%, right?
Yeah.
And so we've lived for the past 40 years, effectively, we've lived in this declining interest rate environment,
exactly.
right? So
never gone back to that high.
a lot of people don't think about it this way, but that has been a massive stimulant to the economy.
Totally.
Right? Because that makes that if interest rates are at 20%, well, the amount of money, because of the fact that people don't buy their houses cash. We are live. Yes, we are, Mr. Sneller. What's going on? I'm also simulcasting this on TikTok right now, trying to be live there as well. So this is like my first run. So TikTok guys, thank you for being here. If you have any comments, make sure you comment. I'll try to get with you. But yeah, this is awesome. So, but here's the deal. We look at this past 40-year period, and when interest rates were at 20%, he hit the nail on the head. You don't qualify for a house based on, hey, you can afford a $400,000 house. You qualify for what you can afford per month, right? And that's, housing prices have been impacted and gone up in value. Thank you, Matt. Thank you. They've been impacted in value based on the fact that interest rates have been coming down over a 40-year period, and also new programs have made it easier and easier and easier for people to get into houses with smaller down payments, with all these different things going on. And so what we want to make sure is, you know, while we have to take all that stuff into consideration, what's really, really important is that we understand that moving forward, we're living in a completely different market environment. So the next 40 years are not going to look like the last 40 years because we're at the bottom. We're at this low interest rate environment where interest rates are going to remain level or they're going to be increasing. And how that's going to impact people is probably going to be a little differently than it would have impacted people in the past. Because we have all sorts of other analytics going on too and factors. And so one of the things that I want to talk about that I'm going to let you really deep dive it, right, is the number one indicator. And we all like to talk about this stuff. I'm probably one of the worst culprits of this, by the way. I always love to talk about the fact how interest rates and what you can afford monthly and why it impacts prices the way it does, right? So typically speaking, for every 1% of increase in mortgage rate, historically speaking, you will have a 10% decrease in purchasing power for the house. So if you could afford a $600,000 house and the interest rate goes up 1%, you can now afford a $540,000 house. That's kind of the rule of thumb that people typically follow. But right now, we've had them go up literally from 3% to 5.5%, and prices are still going up. And so there's this big disconnection, and that really ultimately comes down to the one greatest indicator that nobody's really talking about, and that is supply.
That's the only thing. So here's the thing. Most people don't say this, but I'm going to be bold and say you cannot have a crash. You cannot, TikTok, you can't have a crash when you're have more demand than you have supply. You can't do it. It can't fundamentally happen. And as scared as we are about inflation, there are some benefits to inflation. Number one, inflation usually happens in strong economic times, which is one thing. Number two, as Robert Schuller said as well, he was asked recently in the last few weeks, my financial advisor works with Robert Schuller on some stuff, and he asked, how are we ever going to get out of our country's debt? And he said, the same way we did in the 20s and 30s, we'll probably inflate our way out. Because when inflation goes up, the government can collect more dollars on tax, and they can apply that to the debt. So one of the benefits of one of the ways we get on this debt is inflation. So don't look at inflation as a bad thing. Number one, when things start inflating, focus on your income, not what you pay for things, first of all. Focus on what you make, not what things cost. Stop griping about $4.50 gas. That's what, I mean, if I could just say this, that's what people, that's a poor mindset.
Poor person thinking.
Exactly. Who cares what gas is? Literally. Go play, you know, I play a lot of golf. That's one of my favorite things. And one of the things I love to do is I've committed myself to never checking what green fees are before I go, because it doesn't matter to me. I don't care. I want to be able to say, listen, if this is a valuable experience, I'm going to do it. So first of all, stop focusing on what things cost and even interest rates. Start focusing on earning. Earning makes inflation, I'll say, your servant. It makes inflation your servant, so I don't drop any swear words on Chris's channel. But the truth is, it makes inflation work for you, right? And so in an economic time like we're having, you can't have a crash without that supply passing demand.
Totally.
That's why 0809 crashed so hard. We had a massive foreclosure, massive inventory in a short period of time was thrust to the market, and the buyers couldn't support it.
Yep.
So then we had a crash. Right now there are 14,000 real estate agents in the city of Denver. There's 832 listings. So you tell me how far we have to go to catch up with that.
That's a real number?
That's a real number.
That's insane.
That's a real number. One of my friends.
8,000 listings.
Yeah, no, there's 800 listings. There's 14,000 agents, and it's the same for Austin, Texas. It's in the hundreds. It's like less than 1,000 homes for sale.
Wow.
And it's so for these high sought after markets, we will have that supply demand. We just won't. Until that shortens, we have 4.5 million more buyers in America right now than we have homes.
Okay.
And same with multifamily. We have almost 5 million more people looking for multifamily units than we have units to give them. And so with that much demand, it really is going to be tough to see a crash. And with rising interest rates, one of the benefits of rising interest rates is it often will hedge a crash. It will often make it so it doesn't happen because the easier banks give away money, we found this out in 0809, and the lowest interest rates, and people are leveraging houses and only putting 5% down and getting mortgage insurance and all this stuff, that's what crashes out markets. And so when I see the interest rates going up, I'm like, that's good. That's a little bit normalization, right?
Totally. I saw a thing, I think Bigger Pockets, I watched this video the other day, and they put out some content, and it was like, in a normal economy, in a normal real estate market, we typically have, it was like 1.6 million properties listed. Like
in the United States.
In the United States for the MLS. Like just on the MLS listed as available properties to buy.
Sure.
So that is kind of like the normal long term, and that can fluctuate by 100,000 here and there.
Yep.
We're at 600,000 right now, right?
Half.
We're not even.
Would you say 1.2 million?
1.6
Oh,
million.
yeah, less than half.
We're at 6. We're basically just about 40% maybe of traditional or typical levels. And so, there's some things that are happening that are maybe a little concerning. There are people that maybe have gotten caught, right? So if you just bought a new build, let's say in December, and that building is going to take 6 months to build out. So I read an article on this in Arizona. This is happening a lot because there's a lot of new builds. So you buy a new build in December when you thought you could qualify to get this house at 3%, but now you're going to have to pay 5.5%. You might not qualify for that home anymore.
Changes completely.
So for these new builds, there are people that are going to get caught in that, and that's going to help put a lot of homes into inventory, but it's not going to make up the difference. It's just not. So we have a long ways to go, and it'll be interesting to see how it all plays out.
Well, Ian, because we had a moratorium on foreclosures in the last 2 years, essentially, when you moratorium foreclosures like that, that's yet another block to inventory, right?
Yeah.
And so, in 0809, foreclosures are what thrust everybody to the market.
Totally.
We don't have foreclosures anymore. Now, those are starting to rise, but here again, you have these fix and flippers and wholesalers and investors that have been sitting on the sideline like a pit bull in a cage with all kinds of capital ready to bounce on these things. So they're not on the market but 2 days.
We got this question here.
Yeah, bring it.
Is it a lack of housing or a surplus of buyers? If the latter, why so many now?
Yeah, that's a really great question. It is actually a lack of housing, and I'll tell you why. The only way you have more buyers is when you have more people. So think about this for a minute. We didn't change really the numbers of the United States citizens that much in the last few years to create this. It's not like everybody became buyers. In fact, the trend shows we're actually becoming, one of the reasons I'm in multifamily real estate, the trend is becoming a renter nation. We're becoming a more and more and more of a renter nation. Especially millennials and down, they don't really want to own a lot of stuff. They like the minimalist thinking, the minimalist lifestyle, and having a unit where, in fact, I have a friend that lives here in Scottsdale. He owns a company, makes $37 million a year. He lives in a one-bedroom apartment, doesn't even own a car. And he's 29 years old.
Sounds like our buddy Mike Wolf.
Exactly.
He's got all the money in the world. He just doesn't want a home.
But that's the point. So the idea is that because we're becoming more of a renter nation, we're not having a lot more buyers. The buyers haven't really been thrust to the market. Totally. Now, what COVID did do is it moved some people around. So it took a lot of Californians and moved them east to some cities just inside that border, like Boise, Salt Lake City, Denver, Las Vegas, Phoenix, where Chris and I live. These cities that are inland, even Montana
Heck, they even
exploded.
went to Austin a lot.
A ton of them went to Austin.
Yeah.
So they moved a lot of these inland cities, and this is one of the reasons why, like Phoenix, you could buy a $400,000 home 2 years ago. Now it's $650 because you have California money coming in, and they sold their house in California. It was $1 million, maybe even paid for, and they can pay more because they're paying cash. So it drove up. So some of these pricing in some of these cities are a little fake, but I will tell you this: we don't really have a lot more buyers because of what Chris just said.
Yeah.
1.6 million listings, now 600,000. That's not a buyer issue. That's an inventory issue. That's a listing issue.
Right.
That just shows our MLS is really, really light right now.
Let's just say, like, let's just use common sense when we look at those statistics, right? Like, and this is just the way my brain works when I look at this stuff, right?
Sure.
I go, okay, let's say we had a slump in actual demand, right? Like, so a normal market, we need 1.6 million houses in inventory throughout the United States. So if that's a normal inventory, let's say we go into a recession, right? And demand slumps to 1 million.
Yeah,
you know?
we're still
we still have a 40%.
Yeah, we still have a big buffer.
It's really, really bad, right? And I don't think there's going to be a flood of people just being like, I need to sell my house. Now, there could be some of that. You know, there may be some of that, but I don't think it's going to make up for the amount that we need to actually create a housing crash.
Well, and think about this again. We go back to just the mechanics of an economic real estate crash. Just think about the literal mechanics of what causes it. Supply, demand.
Yes, it is.
But think about this. Another thing that drives it is the loss of jobs. It's the removal of industries. It's when people can't get jobs, right? And we saw back in 08, 09, unemployment skyrocketed. Some cities, it was like in Elkhart, Indiana, who's basically in Detroit, Michigan. You know, you've got a car town and an RV town. That's pretty much what drives that economy. Those industries went away, and they had employment rates in the 12, 13, 14%. Unbelievable unemployment rates.
Yep.
Well, right now, drive down any road in your city and everybody's hiring. Yet another reason that says, I don't know that the mechanics are there. I don't think that the recipe for a crash is people losing jobs and supply outrunning demand. And right now, those two things to have happen, they're the exact opposite.
Sure.
It's the exact opposite.
So we got a TikTok comment here.
Boom.
In the United States, there have been more deaths than births, so the U.S. population is declining.
Yeah. And the only thing that changes that is immigration. So we have a lot of people moving here, and depending on how many people get their citizenship and how many people move and actually add to that population. So we have more deaths than births, but we do have immigration because let's be honest, the United States is an amazing place to live, and so people want to come here and live. So the only thing that tips that number is people moving here.
Totally.
And that can increase
100%.
And bring in families.
So do you know Harry Dent?
Oh yeah.
So he wrote the book The Demographic Cliff, and he talks about this, right? So it's a big deal, and we go through cycles, right? And so there are going to be demographic slowdowns in this country, but it's not going to shrink. Our demographics aren't going to shrink so much that it's going to make up for that surplus. Now, we need to build more houses, and we still have a surplus to deal with to make up for. And so from that perspective, let's kind of start wrapping this up a little bit. But what do you think? What is your prognosis? Just out
what's going to happen?
You know, because I know we've talked a lot about it. So I guess just to kind of prime you a little bit here, if you can, we've talked about the fact that we think that this the corrections are going to be. It may be widespread, but I think it's going to be more segmented.
Regional. It's going to be regional.
There's going to be pockets that are going to be really impacted.
Yeah.
Mike Wolf always talks about invest in the path of progress.
Absolutely.
Right? So like places like Phoenix, that
are growing,
like
the growth pattern.
Where we are filming this right now, I have the new Intel plant, or not new, but it's an old, but they're building like a $21 billion addition, hiring 9,000 new high-paying jobs.
9,000 people.
Like all in 2.5 miles away. So I'm looking at this going like, oh my gosh, like this place is not going anywhere. Chandler is becoming a mini Silicon Valley. Its own. So all these companies looking to escape California and the taxes and everything, a lot of them are coming here, right?
Yeah.
So when we look at pockets, our area is pretty insulated, right?
Yeah.
So where do you think are places that are good? Where do you think are places that you would avoid? Or, if you can cash out now in certain areas, where would that be?
So the places that are going to continue to swing strong are places that are, first of all, business and entrepreneurial friendly. Because like Atlanta, 36 companies over the next 3 to 4 years have stated they're moving headquarters to Atlanta, Georgia. Well, what is that going to do to the real estate? It's going to jump it up because there's going to be millions more jobs there.
Right.
So the point is, the economies where companies want to move. That's why Idaho's blowing up, because it's such an entrepreneurial friendly place to run a business. That's why California's hard right now. They're hard on entrepreneurs. My buddy owned an insurance company there, and he was paying nearly 62% tax with everything he had to cover. That's really hard to create a profit.
They're hard on land.
And they're really hard on
like
landlords.
Tenants.
Yeah.
Or, I mean, not tenants, but landlords.
Yeah, they're really, really hard. So continue to target cities and target buying in cities where business is entrepreneurial friendly. Because it's interesting. We've seen in Phoenix what a dollar could buy 5 years ago in Phoenix is significantly less. But here's an interesting stat that Schuler came out with. What a dollar could buy 6 years ago in Chicago can still buy that same amount in Chicago. Now, you need more dollars to buy the Chicago, but Chicago's dollar has not inflated to the point where you can buy less because more people are moving away. Metro, especially, I think with Metro COVID, I think shot people out into the external areas, not just because people were nervous about the virus. That may be a part of it. But the biggest reason is people, especially business owners, are like, man, I got to get to a place that's a little more comfortable to run my business because they were shutting businesses down. And so a lot of people moved their companies. So I think a lot of big metro, Boston, New York, Chicago, LA, Seattle, those big high metro cities, I think that it's interesting because they're not inflating as much as some of these cities like Phoenix, Atlanta, Austin is probably the highest inflationary. Phoenix is second, Austin is first of what a dollar can buy. So I think moving forward, again, focus on earning and focus if you're going to buy housing. The other thing we didn't talk about, Chris, I wish we had time to talk about, there's a difference between housing and investment in real estate.
Yes.
There's a difference between buying a home and investing in a piece of real estate. So there's a time when I think you should not buy a home, and there's times when I think you should not invest in real estate. And when I say not invest, I'm saying there are certain strategies. Like right now, I would not invest in office and retail. I think that real estate is too shaky because of what just happened. But right now, I would say invest everything you got in multifamily storage units, mobile home parks, and industrial. They're powerful assets. So we're talking about the crash. We're talking about the housing crash, buying your own physical residence. We're not talking about the
personal residence.
Personal residence. We're not talking about investing in real estate.
Like a primary home.
Your primary home. Yep. Yeah. So moving forward, again, focus on earning. Don't focus on earning. Focus on getting the best interest rates possible. They have tailed off. Getting the best interest rates possible. Continue to hold. If you're going to buy, look at cities that are entrepreneurial friendly. Because again, I think you can't really have a crash when you have 800 homes in a city like Austin.
Not only that, like guys, the number one thing that has a negative impact on markets is simply uncertainty.
Oh,
period.
Man, it's
right?
Perception.
It's uncertainty and perception
totally.
and uncertainty and this is what's going on in the world right now with the stock market kind of bouncing all over the place. It's the uncertainty that Jerome Powell says he's going to do one thing, and then he says another thing, and then he meets with somebody else and changes his opinion and flip-flops. And when people don't know what they're gonna, what they can expect, that uncertainty leads to market fluctuation, volatility. People lose a lot of money, and it's the same thing with this. Is if you're an entrepreneur, if you're a real estate investor, where you're a landlord and you want to be in an environment where you have more certainty and you have more control about the success and the outcome of your business on every component of it, right?
Totally.
So like you can go to more liberally leaning states like California and New York and Massachusetts and Chicago,
Illinois,
where if you have these businesses, we don't know what's going to happen. If there happens to be this wave of COVID, which I don't think is a real thing anymore, but a lot of people are still thinking in the back of their mind, like, what happens if? Right? You know that business is going to get shut down, where like you go to a place like Phoenix or Texas or Florida, you move to those places, or Georgia, you go there and you're like, okay, not only are they friendly, like if there's a wave of COVID again, they're basically going to be like, okay, whatever, we're over this crap. Keep going.
Exactly.
Like we're just going to keep the business going. And so from an entrepreneurial perspective, that gives you the confidence that you're in control of your destiny and your success. And listen, how many people lost their businesses? I don't know everybody watching this, what your experience is, but I know a lot of businesses that were cash flow positive before COVID that went out of business because
absolutely, especially service industries and restaurant industries, they took a big hit. So again, response to the content of a quote unquote crash is we look at where we buy. continue to make an offer. When my wife and I tried to buy a house here, we made offers. We would not pay 15% more than the asking price. We're like, no, we'll just wait. And we waited, and we got in on a place, and now our place we bought, it's in 2 years, it's gone up nearly $200,000. So if you just, again, don't be stupid. Don't be stupid and overpay for something, because then you are going to not get your money back.
Right.
If your point is preserving capital. A lot of people don't buy primary residence to preserve capital.
Right.
I do. I can't stand losing money on real estate. It's just in my blood. But if you don't really care and you're like, hey, that's what California said. I don't really care if I lose money with my house. That's not my house isn't to make money. I make money in my business. I just want to live in a place that I enjoy. Right. And if that's you, buy wherever you want to. Just understand what you're getting into.
Totally.
You know what I mean?
Guys, I hope that makes sense. If you have any questions, if you're watching this on the replay, or if you just didn't get a chance to ask a question, go ahead and comment in the comment section below. We do our best to engage with every single comment that comes through. Also, if you haven't already, go check this guy out on YouTube here, Mike Fritz. And by the way, if you're watching on TikTok, you can follow this live as well on YouTube. Go to youtube.com/life180. It'll bring you there. And you are youtube.com/Mike Fritz, right?
Mike Fritz Real Estate.
Fritz Real Estate.
Yep, Mike Fritz Real Estate. You got it.
So go check him out. Go check us out over there if you're on YouTube, or if you're on TikTok, check that out. And on YouTube, guys, have a blessed, inspirational day. Look forward to seeing you on the next video. And until then, go crush it.
Have a good day.